It was the year before the Black Monday crash. Wall Street darling Larry Fink suffered a $100 million trading loss.
I was so angry at myself. I was just mortified at myself.
Humiliated, Fink now is forced to leave the company. But upon his failure, he will build the mightiest company in the world, BlackRock.
Hour after hour today, wave after wave of selling hit the stock market.
Another too-big-to-fail asset manager which handles over $7 trillion in direct management and another $20 trillion through their proprietary software.
Panic, the professionals call it. By the closing bell, the Dow Jones Industrial Average was in the steepest fall in its 103-year history, down more than 500 points.
California is on the rise to become the most populated state in America. Like the rest of the country, the 60s was a turbulent time for California, a decade.
It was such an exciting, heady time to find out that under the official reality, there was this seething turmoil of young people learning new music, new thoughts, new ideas, new literature, new poetry, new ways of being.
Larry Fink is one of those young people. He enrolled in UCLA to pursue a political science degree, hoping one day to make impact as a politician. After getting an MBA degree from UCLA, Fink takes a job at a leading investment bank, First Boston, as a bond trader. It was a perfect time to get into the bond business. In the early 70s, bonds were very popular, only began to be actively traded. Larry Fink excels at this job. He rapidly rises through the ranks, becoming the youngest manager at his department.
Started at First Boston in 1976. I was the first Freddie Mac bond trader. And so the mortgage market was just of its infancy. And then in 1982, we had the ability to put a PC on our trading desk. Before that, you had no ability to put a computer on a trading desk. And it was very clear to me that if we could have computing power on the trading desk, we were going to have the ability to dissect cash flows of mortgages. And we were the most profitable component of First Boston in 83 and 84 and 85.
By 1983, the American economy had recovered from a decade-long recession. The nation's top priority was to restore economic prosperity. Upon assuming the presidency, Ronald Reagan focused on revitalizing the economy.
The highest order of business before the nation is to restore our economic prosperity.
His policies included cutting taxes and deregulating Wall Street, which fostered an environment ripe for financial innovation. One such innovation was the creation of mortgage-backed securities. Essentially, these were financial products that bundled millions of mortgages into securities that could be traded by investors. Larry Fink was a key figure in developing this groundbreaking financial tool, which 2 decades later would contribute to a significant economic crisis. In the meantime, however, Fink successfully marketed these securities to major investors, such as pension funds and endowments, generating tens of millions of dollars in fees for First Boston. At the time, First Boston was a leader in investment banking, specializing in mergers and acquisitions. After delivering $1 billion in profit for the firm, Larry Fink earned the title of its most profitable employee.
When you're at that level, and you've had all of that success, and you have all of this money, there's a mindset that you're almost invincible.
But then, in just 1 quarter of 1986, he loses $100 million. This was a year before the infamous Black Monday crash, during a time when the market was still in a euphoric state, with everyone seemingly making money.
So you could work a lifetime creating wealth under certain assumptions that something can't happen. And then, bang, you lost everything for your whole lifetime because you thought it couldn't happen.
Unless you're hedged against events like Black Monday, one big loss can wipe out all your gains. The same holds true for reputation.
Unless you're hedged for events like Black Monday, whatever alpha you think you're going to get, you're not going to get it.
When you started having those types of successes, the firm gave you more capital. We were taking bigger and bigger risks without the attended risk technology to navigate that risk. And in the second quarter of 1986, we lost $100 million.
Although he wasn't fired, he was sidelined. Suddenly, people avoided being associated with him. He became untouchable. The message was unmistakable. It was time to leave. The problem, however, was that with his damaged reputation, no investment bank was willing to hire him. At just 36 years old, Larry Fink found himself unemployed.
I said to myself 30 days after we lost money in that quarter, even though we made 130 the first quarter and lost 100 of it in the second quarter, I said I'm leaving. But it took me a year and a half because I never ever thought I was going to leave, but it took me a year and a half to try to determine what I wanted to do next.
Always a fiercely competitive man, Larry Fink refuses to accept defeat and is determined to reclaim his former success at any cost. This time, he decides to start his own business, but to do so, he needs investors. Given his tarnished reputation, securing funding seems nearly impossible until he crosses paths with the legendary Steve Schwarzman. Steve Schwarzman, the founder of Blackstone, would go on to become one of Wall Street's most influential figures, transforming Blackstone into the world's largest private equity firm over 3 decades. However, in 1988, Blackstone was still a relatively obscure consulting firm. Like Fink, Schwarzman was also a Wall Street outsider. Once a rising star at Lehman Brothers and a contender for the CEO role, he was forced out after a bitter power struggle, leaving him to carve his own path.
I saw a lot of behavior that I didn't like, and so decided to go out and do something with my partner who'd been thrown out the year before by the management that went in and ultimately blew up the company.
In 1988, Blackstone had only just begun its private equity operations and had barely completed its first deal. Despite this, Steve Schwarzman was already envisioning bold expansions for the company, including branching into wealth management. One of the keys to Schwarzman's remarkable success was his ability to recognize and attract top talent. He had a keen eye for identifying the best people to help drive his ambitious vision forward.
We wanted to attract somebody to run it who was a 10 on a scale of 10. Because you'll find in your careers, if you're a 10, God bless you, you'll be wildly successful. If you attract 10s, they always make it rain if you need rain. And they just have an ability to sense problems, design solutions, do new things, and that's what a 10 does.
After meeting Larry Fink, Steve Schwarzman decided to invest $5 million to establish a joint venture called Blackstone Financial Management with him. It's important to distinguish between an investment company and a fund, as they are often confused. In this case, Schwarzman provided $5 million to launch the management company.
It took me a year and a half to assemble my thoughts, and I told the story to Steve Schwarzman and Pete Peterson, and they loved it, and they had more confidence in me than I had myself. They wanted to go right ahead, and we did that, and it all, we actually started making money within 2 weeks.
But Fink and his team still needed to raise capital for their fund. Within 5 years, Fink had grown the fund to manage $8 billion in assets. Along the way, he internalized a critical lesson: always be mindful of risk. One of his core investment principles became clear. He would not commit a single dollar unless the risks were fully understood and calculable.
There were so many other companies that really didn't understand the risk, and most importantly, the buy side, the investors had no idea the risk they were taking. And there was a great need for a company that starts off with a high concentration in risk analytics, and principally in the fixed income area. There was a lot of analytics in equities back then, but nothing in bonds.
He was among the pioneers in using statistics and algorithms to guide investment decisions. Now, back at the top, Fink understands that for his company to expand further, it must offer more stock options to attract top talent. He insists that Schwarzman invest and give up a portion of Blackstone's ownership. To his dismay, Steve Schwarzman rejected his proposal. Both Schwarzman and Fink are highly competitive type personalities, but while Schwarzman is an investment banker, Fink takes more of a trader's approach.
Steve Schwarzman, he's unusually conservative, actually unusually risk-averse for a successful entrepreneur and investor. This was a visceral thing, like a primal impulse not to lose money.
Two alphas are bound to clash from the start. After Schwarzman rejected his proposal, Fink became determined to sever all ties with the firm, seeking a buyer to acquire Blackstone's ownership. Meanwhile, Schwartzman was dealing with a personal divorce, and the news that Fink wanted to leave sent him into a frenzy. Ego plays a significant role in business. Ego plays a significant role in business, but it can also ignite conflicts.
Ego is a great thing in business. An ego. You show me a titan of industry, and I'll show you somebody with a big ego.
In the world of Wall Street, everything has a price, including ego. PNC Bank, or Pittsburgh National Corporation, is a long-established finance group with a storied history. In 1991, the bank was on a buying spree, acquiring dozens of smaller firms. It was the perfect buyer for Fink, who wanted to divest Blackstone's stake. PNC offered hundreds of millions of dollars to buy out Blackstone's share. Consider this: Steve Schwartzman and Larry Fink started Blackstone with just $5 million. That's an enormous return in just 5 years. Though Schwartzman was still hesitant, the offer was too good to refuse. He agreed to sell Blackstone's asset management business to PNC, marking a fateful mistake in his career. At the time, even Schwartzman couldn't predict that this side business of Blackstone would one day surpass even Blackstone itself in size and influence. In 1994, BlackRock was still small by Wall Street standards, with an $8 billion fixed income portfolio, a modest figure as bonds typically offer lower returns and come with less risk. Now free from Blackstone, Fink was determined to grow BlackRock in his own vision.
Old kitchen.
Yeah. Smile.
GE, we bring good things to life.
But to succeed, he needed an edge, one that would come from an unexpected source. Under Jack Welch, General Electric, GE, experienced explosive growth in the 1980s, fueled by easy money. GE expanded into new industries, including news and finance, acquiring Kidder Peabody, a respected investment bank. However, Kidder Peabody became embroiled in insider trading and accounting fraud. Welch, realizing the company's trouble, decided to sell it, and PaineWebber, another investment bank, agreed to buy it, but not its toxic bond portfolio, which included $10 billion in CMO. So, lateralized mortgage obligations, a complex type of mortgage security. Welch, though a brilliant manager, wasn't a finance expert, and he struggled to rid GE of these toxic assets. Only BlackRock, led by Fink, was capable of evaluating and restructuring the bonds. As pioneers in CMOS, BlackRock saw an opportunity to help GE offload these troubled assets, and in doing so, made a massive profit. This became a breakthrough moment for BlackRock, known as the go-to firm for financial engineering. Fink's team of quantitative analysts worked tirelessly for weeks, repackaging the assets into new securities. BlackRock helped GE unload its toxic assets with minimal loss, a process known as financial engineering. This reshaped existing securities into new ones, with some becoming highly valuable, accessible only to big players in finance. By the early 1990s, this financial engineering became BlackRock's greatest competitive advantage. From that point on, BlackRock earned a reputation as a ghostbuster for companies with problematic assets. Fink became the guy to call. The success with GE solidified BlackRock's standing on Wall Street. Just 3 years after separating from Blackstone, BlackRock's assets under management grew by 46%. PNC, BlackRock's parent company, merged its wealth management division with BlackRock, creating a combined $154 billion in assets. Having become a billionaire, Fink did what many billionaires do: collect art. He believed art, alongside real estate, was one of the best stores of wealth, an inflation hedge better than gold for investors with portfolios exceeding $100. Art has seen immense gains in recent years. According to Citi, contemporary art prices appreciated by 23.2 compared to 3.8 for the SIP 500 during periods of 3's inflation or higher. But unless you have $100 million bank, it's difficult to invest in such high-value assets. By the time BlackRock went public in 1999, it had become the 5th largest publicly traded asset manager in the US. But Fink wasn't satisfied. He wanted to be number one. Over the next 5 years, BlackRock continued to grow. accumulating $400 billion in assets. In just over a decade, BlackRock transformed into a financial giant, a monster that only wanted to get bigger. The U.S. experienced a remarkable economic recovery in the mid-90s, fueled by the tech boom and strong growth under President Clinton. Unemployment fell, the stock market soared, and America was once again the epicenter of technological innovation. Fink, who had joined Wall Street in the turbulent 60s and later founded BlackRock, watched as the firm evolved into one of the most formidable forces on Wall Street, managing hundreds of billions of dollars. But as BlackRock flourished, a crisis was quietly brewing. The financial derivatives Fink helped develop in the 1980s had morphed into a ticking time bomb. In December 2000, Congress passed the Commodity Futures Modernization Act, which banned the regulation of derivatives. Investment banks began making billions through the securitization of mortgages and loans, linking them with investors worldwide. While this shifted risk, it also privatized profits, leaving the risk still lurking beneath the surface. As homeownership became more accessible,
real estate is real. They can see their asset. They can live in their asset. They can rent out their asset.
Real estate prices skyrocketed, but so did the risk tied to these financial instruments.
Ripped markets overnight with Asian stocks slammed.
Stocks fell off a cliff, the largest single point drop in history.
Share prices continued to tumble.
In a matter of days, one of the pillars of...
One of the first major banks to fail during the financial crisis was Bear Stearns.
We bought Bear Stearns, and it wasn't bailed out by the government. The government did a little bit of financing. We only did it because we were asked to by Hank Paulson. And we thought if it went down, that could be a huge crisis for the globe.
In response, the U.S. government turned to J.P. Morgan Chase, the largest commercial bank at the time, and asked it to step in and bail out Bear Stearns. Jamie Dimon, the shrewdest banker on Wall Street, wasn't about to acquire Bear Stearns at a loss. So he calls up Larry Fink for advice. Coincidentally, Tim Geithner, who was orchestrating the deal, had also been in contact with Fink about Bear Stearns. In normal circumstances, this would have been a conflict of interest, but Fink's expertise was so well regarded that everyone looked the other way. Soon after, BlackRock was brought in again to help rescue. In fact, throughout the financial turmoil of 2008, BlackRock played a crucial role in nearly every major deal.
And as an expert on mortgage-backed securities, he was called in to help and to clean up. With people like Hank Paulson and Jamie Dimon and Tim Geithner on speed dial, Larry Fink helped engineer a remarkable rescue for the financial industry.
The financial crisis provided the perfect opportunity for Fink to strengthen his position as the new king of Wall Street. After the housing crisis of 2008, issuing and trading fixed income derivatives are no longer the most desirable business to get into. Since the early 2000s, the internet has become widely available, enabling the growth of social networks like Facebook and YouTube.
And now we're at 100,000 people, so who knows where we're going next. We're hoping to have many more universities by fall.
Social media enables virtually frictionless mass communication and a fast flow of information. Fink realizes this change will fundamentally alter the finance sector. From the wreckage of the '08 disaster, one business would explode.
So because of that, we can invest into some of these different funds that are available to us.
Every year, it turns out that probably 2/3 of the active managers are outperformed by the index, and the third that outperform in one year are not the same as the ones who do it the next year.
In his classic book, Running Walk Down Wall Street, Burton Malkiel proposes that a market is essentially random and therefore unbeatable. The only rational thing to do is putting money in everything.
Statistically, this is the simplest way to build wealth for probably 99% of investors.
The best single thing you could have done was just buy an index fund.
Influenced by Molecule, mutual fund legend John Bogle launched the first public index mutual fund in 1975. Starting with just $11 million, this fund tracked the movement of S&P 500. After that, many followed suit. But these mutual funds did not become publicly traded until 1993, when the first ETF was released. SEPDR came to life in the aftermath of the housing crisis in 2009. BlackRock has already begun acquiring ETFs, starting with the E-shares from Burton's Barclays Bank. Through just 3 funds, just like the fishing industry. Very few people get wealthy by hunting whales. Most of the revenue comes from smaller fish with large volumes. I guess to think he realized the future of investing is about tapping into the pockets of smaller investors. Volume over profits. BlackRock soon controls nearly half of the ETFs in America.
They have $50 billion in Lockheed Martin and Northrop Grumman each. And it's been the most successful. It's not a bank, it's just an investment company. And it's been the most successful in the world. So it's huge, it's massive.
In 2014 alone, BlackRock raised $103 billion.
And we're the largest pension manager in Japan. In Mexico, where we are now becoming, we just did an acquisition, we're going to be the largest asset manager in Mexico. We have one technology pipe worldwide that connects everything we do at the firm.
Shortly, the firm becomes the major shareholder of, in almost every public company out there. Larry Fink now has more potential power to influence the US economy than anyone else. He is the JP Morgan of the 21st century. It means he starts exercising his immense power provided by all the ETFs he controls